Let me open the other parts. We'll start. Before we start, any question, confusion you have? Anybody? Any question, confusion?
Sir, I had a question.
Sure.
Sir, like you had talked about, I think in last or second last class, you talked about FIIs and like FDI they get stake and FII they don't get stake. But in FII, do they get voting rights like for decision making?
They have voting rights, but they cannot represent like any other shareholder. You have voting rights.
Okay.
See, so what is the difference? So, but they can, what do I say? There are many shareholders. There are many shareholders who they are considered to be minority shareholders, but there is a limit. They have a cap. So these voting rights, the foreign institutional investors. So there is a cap. They cannot take active part in the day-to-day affairs of the company. Okay.
Okay, sir.
So some cases, especially around 10, I think 10%. So they have a 10% voting rights. Your FIs have a restriction, like your foreign institutional investment can go beyond 10%. See, for example, as I have told you, HDFC and ICICI, these two banks, technically they are foreign banks. Why technically they are foreign banks? Because their foreign shareholding is more than 51%, but their shareholding is restricted to 10%, I think. See, there are different rules, FEMA rules, these rules, that rules, law. Sometimes we forget also. Yeah. Anything else?
Sir, I had a doubt too.
Sure.
Sir, so in Argentinian financial crisis, in the later after the crisis hit them.
Jatin, don't worry. I'll take care of Argentina financial crisis later. We have not yet started that.
Sure, sir.
So because since most of the class have not read none of the cases, probably I'll not do the case with the class unless you read, because what do I do? There is no point in discussing. So whoever has a problem, so we'll definitely discuss. Don't worry about that. So there are two choices. Two choices. One is next class, all of you read the case. Otherwise, I don't do the case in the class. Got my point. So there are certain things which you need to study and then only we can discuss. So that is why the cases were given. So if I next class, I'll postpone this to next class, because what I can find out is only very few, 3-4 people have read, Asian financial crisis, and only you read probably Argentina crisis. I don't find any other answer, because Bridges already said that he read only Asian financial crisis. So cases we'll do slightly later, but before that, let me just do the last part of this parity conditions. So remember the parity conditions which we were doing in the last class? Yes or no?
Yes, sir.
So last class we were doing parity conditions, and there we have seen that we have discussed about purchasing power parity. We have discussed about interest rate parity. We also talked about Fisher effect. We also talked about international Fisher effect. And at the end, we said that today we'll be doing what is the with this, how can we predict the future exchange rate? So how can we predict the future exchange rate? Okay, so can we start?
Yes, sir.
Yeah. So as I've told you, that is, this can be explained. See, normally when I do this with economics honor students, normally we do it with curves, you know, a lot of diagrams and etc. etc. But what I find is with MBA students with mathematical problems, you know, it becomes easier. So let us do with some mathematics. So today's date is 18. So 18/01/2022. Okay. So if I take the examples what we had done in the last class.
Sir, sorry to interrupt.
Yeah.
Sir, I think we haven't covered Fisher effect. I guess from till parity we have done.
So Fisher effect interest rate we have not done.
Yes, sir. Till parity we have done, sir.
We haven't done these things, whatever is going on over there.
Yes, sir. The
So we have
was the last which we ended.
In the last
really
class, we just did we just
nominal
tried
interest
to.
rate is now, can you see the slide?
Yes, sir.
Yes, sir.
Nominal interest rate is equal to inflation plus interest rate, real interest rate, that we have not done.
That we did, sir. Like you'd mentioned, like banks give nominal rate of interest and all.
One thing you can say, I have not calculated real interest rate separately.
Yes, sir.
There is something called, but concept I have explained you.
Yes, sir, you have.
Yes, sir.
So
Concept has been explained.
So this is the one which is Fisher effect. Ideally, this is your home interest rate, your foreign interest rate. This will be equal to home inflation minus foreign inflation. Is that okay? Without any government interference of nominal rates vary by inflation differential. So difference between interest rate should be, real interest rate should be difference in the inflation rate. Yes or no? Tends toward equality. So that is why your Fisher effect comes into the picture. So you might say that I have not done this formula, but this we have discussed. That is why what is the difference between nominal interest rate, what is the difference between real interest rate, and why inflation. That's we have discussed, I believe.
Yes, sir.
Yes, sir.
So probably I did not mention the word Fisher effect.
Yes, sir.
Yes, sir.
So can we proceed further? So now with the help of this, how can we predict the interest rate? So in our example, if you see, what was our spot exchange rate? 74. Achha, before that, what is the formula for, now let me tell you what, there is something called spot market and forward market. Now forward market will be and spot market will be doing in detail when, you know, probably in our next chapter when we will be doing foreign exchange market. But just before that, let me explain you a little bit. You go to the market, buy something, spot market. Any question? So go to the bank, see the rate, pay money, get the delivery of foreign exchange, spot market. Any question? No. Similarly, you go to the vegetable market, pay money, take delivery of the vegetable. Spot market. What is a forward market? Suppose today you don't want to buy. You need the product after 1 year. Suppose you need foreign exchange after 1 year. So you go to a bank and say that you want to buy $1 1 year from now. I repeat, you go to a bank and say you want to buy $1 1 year from now. Now bank must also be ready to sell you $1 1 year from now, assuming that the bank is also ready to sell you $1 1 year from now. So the rate at which you will be buying from the bank and the rate at which the bank will be selling you, same rate. I repeat, the rate at which the transaction rather will take place after 1 year will be determined today. I repeat, go to a bank and say you want to buy $1 from the bank. Suppose today, if you buy, the exchange rate is 74 rupees per dollar. Bank says, okay, you want to buy $1 1 year from now. I will be selling you $1 1 year from now at a price of 76. So today you enter into the contract, delivery of goods, that is delivery of $1, and payment for goods, that is you will be paying 76 rupees. This will take place after 1 year, but the contract is made today. So what is a forward contract? Today you enter into the contract, delivery of goods and payment for goods will take place on a future date. Any question?
No, sir.
Anybody? So now the question is, today how do you know what will be the rate after 1 year? I repeat, today how do you know what will be the rate after 1 year? We know what all factors last class we discussed, mainly the 7 factors which determine the exchange rate. And along with that, we also discussed that how the expectations play a very important role. In fact, you have not read the case Asian financial crisis. There you will see how the expectations play a very important role. Okay, so thing is, when we today you enter into the contract for something which will take the delivery after 1 year, and you will pay for it after 1 year. The price is determined today. Now today, how do you know what will be the price after 1 year? So we have all these parity conditions. They help us to predict the future price. Okay, I repeat, all these parity conditions, with the help of this, we try to predict the future price. Okay, this is one part. And like as I have told you, that is exchange rate does not depend upon only those 7 conditions. They also depends upon expectations. Okay, I'll come to that slightly later. So for the time being, let me write the formula for forward rate. So what is a forward rate? Forward rate is equal to spot rate into 1 plus DIR divided by 1 plus FIR. So what do you mean by F? F is the forward rate. That is what is the, this is expected. Huh? What is the rate? Rate. This is the rate, expected rate after 1 year. What is this? Spot rate, today's rate. That is today if you buy, that will be the rate. What is DIR? Domestic interest rate. Domestic interest rate means in India, it is Indian interest rate. And what is FIR? Foreign interest rate. So if I take our example, our spot rate was, in our example, spot rate was last class, whatever we have done, spot rate we assumed was 74. So spot rate rupees 74. What will be DIR? Domestic interest rate? How much? Nominal, huh? 8%. Any question? So I'm just taking the last class's example. 8%. What is foreign interest rate?
3%.
3%. Yeah.
3%.
So 3%. So if I apply this and try to calculate the forward rate, so forward rate will be equal to spot rate, that is 74 into domestic interest rate is 1 plus domestic interest rate 8%. So 0.08 divided by 1 plus foreign interest rate is 3%, 0.03. So from this I get 1.08 divided by 1.03.
77.59, sir.
So 77.59.
59. Yes.
So rupees 77.59. This should be the rate which we calculated last time, 77.59. Any question? Yes or no? Huh? Anybody? So till now it is fine. That is how we predict. This is a prediction. Or the last class, did I tell you the difference between intrinsic value? This is a term which is mainly used in the stock market. Do you remember the term called intrinsic value and market price? Intrinsic value is the value determined by the investor. So this is the expected value determined by the investor. However, in the market, it might be traded at a price other than 77.59. Now, why the market price can be different? As I have told you, that is not only the interest rate, because normally your inflation, nominal interest takes care of real interest rate as well as inflation rate. But at the same time, you have seen there are so many factors which determine the exchange rate. Okay. Which determine the exchange rate in the sense out of those 7 factors, apart from those 7 factors, you also know that expectations also play a very important role. So it is not only expectations, and there are certain things which you have not talked about. See, you think about unemployment. That also has an impact on the unemployment is definitely a result of many things. If you have more inflation, it is possible that higher inflation, it is possible that there may be unemployment. But normally what happens is when the production grows, there are more employment. Naturally, the prices are likely to rise slightly. So there are different kinds of effects on different items. But point is, in the market, the price at which it is traded is the market price. That part is clear to everybody, and not necessary that in the market it will be traded as a price at a price of 77.59. So you calculated on the basis of the information available, that is spot rate, domestic interest rate, and foreign interest rate. You calculated the expected future rate or the forward rate can be 77.59. So when you go to the market, there are 3 possibilities. That is, price is equal to 77.59. Price is more than 77.59, and the price is less than 77.59. So if the price is 7, yeah.
Sir, I have a doubt in this formula.
Sure.
So it doesn't involve the time factor. So after 1 year also the forward rate will be same, 2 year also the forward rate will be same.
Right now, I'm talking about right now the whatever is available. But are you talking about the calculation part, 77.59 part?
Yes, sir. You told that forward rate is like we would be contracting, buying the dollar on this rate after 1 year, right?
Yeah.
We are, but according to this formula, we will be buying the dollar after 2 years also on this rate, 3 years also on this rate.
So this will be if you buy after 2 years, DIR, it will be DIR square, FIR square.
Okay. Then it will be squared. Okay, sir.
Or maybe normally we don't use square, 2 into DIR, 2 into FIR. This formula, there is another formula that I'll show you. But now let me also tell you that throughout the depend. Suppose today, right now, you go to the market, this is the rates, everything is available, and you calculate. Now for a retail rate 74, if you go to a bank, throughout the day, probably bank will offer you the rate at 74. Of course, there are 2 rates. So this covered interest arbitrage, again, I'll be doing after one problem I'll be doing after foreign exchange market, where I introduce 2 rates. 2 rates of interest, 2 rates of spot rate, etc. etc. That I'll show you later. But for the time being, one thing you can make out, that is here your rate of interest and of domestic rate of interest and foreign rate of interest may not change in every minute, but the spot rate can change in every minute. So normally when you go to a bank will offer throughout the day, bank will probably offer you one rate. But it is when you go to the wholesale market, this rate keeps on changing. Got my point? So in the morning, and it's a 24-hour market, though it's a 24-hour market, but in the morning, in India, when you go to the bank probably offers you 74. After 1 minute, it can be 74.5, depending upon the demand and supply of in the foreign exchange market. So this rate keeps on changing. So if as long as this rate is same, you throughout the day you can get 77.59. Normally, interest rate does not change in a day so frequently, but this rate keeps on changing. Though you can calculate and change the rate of interest, I'll come to that later. See if you actually domestic interest rate, foreign interest rate, which interest rate you use. So it depends upon that. But for the time being, let us assume that interest rate is not changing, but this exchange rate, this spot rate can change. Accordingly, the rate can change. Got your answer?
Yes, sir. Got it.
So have you heard about something called arbitrage, hedging, speculation, arbitrage? Will again,
yes, sir, in the efficiencies.
Yeah. So
Yes, sir.
Hedging is you have a position, you want to manage your risk. Speculators are basically they want to buy at a lower price, sell at a higher price, or sell at a higher price and buy at a lower price, whatever you do. And arbitrager, theoretically, it's a riskless profit. You take the advantage of price differentiation of two different markets. So you buy in one market, sell it in another market. Suppose in one market, potato is 20 rupees a kilo, in another market, potato is 22 rupees a kilo. So the market where it is 22 rupees a kilo, you can buy it there and sell it in the other market at 22 and make profit. So here we can take if there is a price difference means forward price should be 77.59 given the information is available. If the price is anything other than 77.59, so there is a mispricing between spot market and forward market. So I told you the arbitrage is basically the price differentiation between two markets. These two markets can be two geographically different market, and it can be two time-wise two different market. In this case, what is happened time-wise? One is a spot market and the other is a 1 year forward market. Okay, so time-wise, if they are different, there can be an arbitrage. Theoretically, arbitrage is a riskless profit, but the today's world, there are arbitrage where you have a risk. That is, it is not that every time you can make a profit. So there are many things in arbitrage. So slowly, the definition has shifted because of the new instruments or new techniques which are available in the market. For the time being, let us take this example. Case 1. As I have told you, price should have been 77.59. If it is equal to 77.59, nothing happens. If it is more than 77.59 or less than 77.59, so there is a possibility of arbitrage. Let us take case 1. Case 1 is price is less than say 77.59. Okay. So $1 equal to rupees 77. So case 1 is suppose 1 year forward rate is $1 is equal to 77. Make sense? Is that okay with everybody? My rate should have been 77.59, but it is 77. So that means 1 year rate is trading at a lesser price. What do you do? What should you do? 1 year dollar should have been 77.59, but it is trading at a price less than 77. So what should you do?
We should buy that.
You should buy it in the forward market and sell it in the spot market. Yes or no?
Yes.
Yes, sir.
So how do you do that? You don't have. So borrow $1. If you borrow $1, what is the rate of interest you have to pay? 3%.
3%, sir.
Rate of 3% for 1 year. So after 1 year, we will have to repay how much?
1.03.
1.03. Make sense? Convert. How much you have? $1 into INR. So it will be equal to how much? Today, if you convert, what is your spot rate? 74.
74.
Is that clear to everybody? Today you are converting. Today you have $1. 74. Invest rupees 74. If you invest 74, what will be the rate of interest?
8%.
Is that clear to everybody? Invest 74 at the rate of 8% for 1 year. So we will get so if you invest 74 at the rate of 1 year, 8%. 79.92. You will get 79.92 after 1 year.
Yes,
You
sir.
will get 79.92 after 1 year. But what is your situation now? You have a dollar borrowing which you have to repay 1.03, and your rupee deposit will give you 79.92. So buy USD in 1 year forward market at the rate of $1 equal to, what is the 1 year forward market rate? 77. Can you see this? At the rate
Yes,
of so for how much you will be buying? Because your deposit will give you 79.92. For rupees 79.92. So we will have how much dollar? 79.92 divided by 77. Okay, equal to dollar this divided by 77. 1.0379. 1.0379. How much you have to repay? 1.03. So after 1 year, what is your situation? You have a loan of $1.03. Your rupee deposit will give you 79.92, which you will deliver in order to get $1.0379. Okay. So with so ultimately you have $1.0379 on one hand, and you have a loan of $1.03 on the other hand. So after repaying $1.03, net profit
$0.0079.
79. Looks interesting. Huh?
No, sir.
No. Does not look interesting. Multiply this by 1 million.
1,000. Yes.
Then it will look
But-
interesting.
But
Huh?
instead of Instead of 77.59, we took 77 now. So there are chances to
What chances? Clearly,
forward
clearly.
rate.
Huh?
Forward rate can be more than 77 now.
You go
So
to the
that case-
market. Suno. Let me clarify. You go to the market. There is a forward market. Huh? You go to the market. You see spot rate is 74. You see domestic interest rate is 8%. You see foreign interest rate is 3%. You also see that the forward rate is 77. Forward rate is also available in the market. So there is a forward market. So today you go to the market, as I have told you, go to State Bank of India and say, I want to buy $1 after 1 year. State Bank says, okay, I can sell you $1 after 1 year at 77. And immediately you calculate and see there is an arbitrage opportunity. So what you do? Today you borrow $1 where you have to repay $1.03 after 1 year. Immediately convert that dollar into rupee, you get 74. Immediately invest that rupee in the bank and at the rate of 8%. So this is also certain. So bank is going to give you 79.92 after 1 year. And immediately you enter into a contract with SBI where you can buy $1 after 1 year at a price of 77. So all these transactions are done right now. And once it is done, forward contract, there is an obligation. So once SBI agreed to sell you at a price of 77, irrespective of the price after 1 year, you will be delivering 77 rupees to SBI and SBI will give you $1. Okay. So after 1 year, once you get 79.92 from your bank deposit, that you deliver to SBI and take a delivery of $1.0379. Now, where is the problem here? Any question?
Sir, I have one doubt, sir.
No, sure.
Sir, how to borrow $1 at 3%? Can retail investors borrow that? And how to borrow?
I'll come to that later. This is last answer. Huh? Any other doubt? Whether you can do it in simple term. That is your question.
Yes.
Yes and no. For you, answer is.
That's the question, sir.
So for you, answer is no. Why? So when we'll do foreign exchange market, we'll discuss this. So there are a lot of restriction in India for borrowing and lending dollar. So you can't actually borrow foreign currency. Similarly, you cannot, without any reason, you cannot buy foreign currency. Okay, so that we will do when we'll do foreign exchange market details. Huh? So there, and these laws keep on changing. It's not that whatever laws are there, in fact, they will be there for the rest of your life. Yeah? So they keep on changing depending on the market scenario. Okay. So now, question is, in fact, government is also going to change one law very recently, because government is going to introduce T+1 settlement, and again there will be a change in the law. Otherwise, it will be difficult for the foreign portfolio investors to invest. Anyway, I'll come to that later. It is all the proposal has gone only on day before yesterday. So naturally, it will take time. So since there are a lot of restrictions in India, you cannot do it, but the corporates, they can manage to do it. It's not that they cannot. What about other developed countries where there is no restrictions? Of course, there are people who do it. Now, since from India, you cannot do it. So that is why it is possible that your actual rate should have been 77.59. Actual rate should have been 77.59, but it is trading in the market at 77. But if you go to US, where it is easy to borrow foreign, there is no restriction on borrowing and lending foreign currency, there these anomalies or differences will not be there. Got my point? So since there are restrictions in India, that it is possible that you have a difference in rates, because in US, suppose there is a difference in rates, so immediately a lot of arbitrators will jump on this and they will try to do it. And as soon as they will do it, what will happen? So there will be a more, because everybody will start borrowing dollar. So first of all, the interest on dollar can go up. Number one, once they borrow dollar, they convert the dollar into rupees. So there is a selling pressure on dollar. So as soon as there is a selling pressure of dollar, the exchange rate is likely to change, and there is a buying pressure in the forward market. So this exchange rate is also likely to change. So eventually this demand and supply, or this arbitrager, they will make the rate equal. Got my point?
Yes.
So the entire finance is depending on this theory of arbitrage. So this up to this is all right. Can the rate be other way around? Case 2. So this one we have done if the rate is more than 77, less than 77.5 times. So let us take one. The rate is more than that. Suppose one year forward rate is $1 equal to rupees. How much was that? 70. How much was that? 77. So let us take 78. Huh? So here what is happening? The dollar in the forward market is more expensive. So you buy in the spot market, sell it in the forward market. Make sense? Yes or no?
Yes, sir.
So how do you buy it in the forward market? So borrow, let me do it 1 rupee only. Borrow rupee 1. If you borrow rupee, what will be the rate of interest? 8%. Huh? At the rate of 8% for 1 year. So we will have to repay how much?
1.08 rupees.
So rupees 1.08 after 1 year. Okay. So convert rupee 1 into USD at the rate of $1 equal to rupees 78. Huh? This is the rate given, 78. So we will have $1 divided by 78. So equal to
0.0128, sir.
Achha, 1 divided by 78. 0.0128. Huh? So $0.0128. Is that okay?
Sir, I have a doubt. So
Sure.
when we are borrowing rupees 1 from the Indian market, so we will get to convert that rupees into the means by the spot price of the market, na? Like
Yeah.
it should be $1 equals to rupees 74.
Absolutely correct. Absolutely correct. Correct. I'm so sorry. So my spot rate is 74. I convert at 74. Sorry. Absolutely. Thank you for rectifying the mistake. So 74. So 1 divided by 74. I just missed it. 1 divided by 74. So comes to 0.0135. 0.0135. Okay. Is that fine to everybody? With everybody? 0.0135.
Yes, sir.
Invest $1 0.0135 at the rate of how much percentage? 3% for 1 year. So we will have, so if you multiply this by 1.03 into 1.03, so it comes to 0.01434. We'll have 0.01434. Check, huh? Check. Let me calculate 1 divided by 74, that is equal to 0.0135 into 1.03. Got it? 0.0139. Is that fine?
Yes, sir.
Sell $0.0139 in 1 year forward market at the rate of $1 equal to rupees. What is the rate?
78, sir.
78. So we will get into 78 1 point. Yeah, 1.0857, huh? We'll get rupees. How much we got? 1.0857. 1.0857. So how much you'll have to repay?
1.08.
So we'll have to repay 1.08. So profit
0.0057 rupees.
$0.0057. Makes sense? Again, multiply by 1 million, 1 rupee, it's nothing, but multiplied by 1 million will give you some amount of money. Make sense? Huh?
Yes, sir.
Any question? This thing, I can't make out whether you have understood this or not.
Sir, I have a question.
Aja, before you ask this question, we'll also do this problem with a lot of complications later. And this entire process, this thing is called covered interest arbitrage. So first, what we have done before you ask the question, so this is with the help of these parity conditions, how we predict the forward rate, and if it must be, so that is why in the chapter it is written unbiased forward rate estimator. So if your actual rate is different from this, so there is an arbitrage opportunity. This is how we do arbitrage, and this is called covered interest arbitrage. Okay, yeah, Jatin, your question.
Yes, so when we sell the dollar in the forward market, are we selling at the same time when we buy the rupees or after 1 year?
All transactions are today. Delivery is after 1 year. So forward market will do slightly details, definitely. So all transactions are today. Delivery is after 1 year.
Sure, sir.
Okay.
Thank you.
Any other question?
No, sir.
Anybody else? So covered interest arbitrage is done. Right. Now we'll start a new chapter. So first tell me, what do I do with the case? Yeah. Who is this?
Sir, sir, a follow-up question on the previous one. So the for the payment will also be after 1 year, or the payment will be today when we talk about the forward market?
Which
Or
payment?
would there be a margin or something like that?
Margin, since you raised, I'll answer. But since you said, first of all, payment for the forward will be after 1 year. Now,
like the complete, I'm asking if the complete payment would be today, or like how would it go?
Suppose 1 million, huh? So 1 million is a lot of money. $1 doesn't make sense, huh? Let me take. Suppose you borrow 1 million rupees at the rate of 8%. Okay.
Right.
So you'll have to repay 1.08. Convert 1 million rupees into dollar at the rate of 74. So you'll get this much million. So invest this for 1 year. You will have this. You will have this much. You have not received this in your hand. So you have this much. And now you are selling in the forward market at this rate. Now your question is, when you sell it in the forward market, what is the guarantee whether you will have to keep a margin or not? Similarly, when you buy it in the forward market, in this case you are selling, and there when you are, now always remember, when you buy one currency, you sell another currency. Okay. For the time being, here you are selling the dollar, and there in the previous example you bought the dollar. Your question is whether you need to keep any margin or not. Is that clear, Nikhil? Stray?
Yes, sir.
So the answer is yes and no. If you go to a bank and say, I want to buy something in the forward market, bank will say that you keep some deposits. Okay. So if you ask why, the bank will say, what is the guarantee that you will, after 1 year, you will come and deliver me the rupees and take the delivery of the dollar. See, for example, here, if you see, when we bought the dollar here, buy USD in 1 year forward market at the rate of 77. So after 1 year, you find that dollar is trading in the market at a price of 75. That is the spot rate after 1 year. So you may not go to the bank. You sell it you buy it from the market at a price of 75. So you will be definitely getting more dollar. Your profit will be more. So bank can say that you would keep some deposit. And similarly for this case also, when you buy or sell to a bank, bank can say you keep some deposit, because what is the guarantee that in this case also you are selling at a price of 78. Suppose the price after 1 year, $1 is 79. So you will definitely sell it in the market to get a higher profit, higher money. So bank can always definitely ask you some amount of margin. The thing is, legally, you may not pay any margin, or you are not supposed to pay any margin in forward contract. However, suppose Reliance Industries go and they enter into a contract where they will buy or sell in the forward market. The bank will definitely not ask Reliance to keep the margin. The reason is very simple. It is expected that the Reliance will not run away. Okay, the bank will expect. If suppose Reliance goes to State Bank of India, says that, okay, I want to buy or sell this after 1 year. State Bank says you have to keep margin. Reliance immediately said, okay, I don't want to give margin, and if you ask margin, I'll go to my other banks. So other banks will do it. Got it? But you don't have that choice. Wherever you go, they will ask some margin. However, a similar contract is future contract, where payment of margin is compulsory. So we'll do future contract later, definitely. We'll do future contract later. Any other question? Anybody, any other question?
No, sir.
So can I go to the next one? Now tell me, what do I do with the case? Since most of you have not read, postpone to next class.
Yes, sir.
So,
Yes.
Pranav, what is the guarantee that next class everybody will read the case?
Sir,
Yeah.
apologies, but we'll ensure that, sir.
How do you? How? It's nice to hear that you said that you will ensure that, but how? See, I shift to next class. Let me start another chapter. So if you don't, naturally we'll go to something else. Will not do the case because there is no point in doing the case without reading. So your class is, I think, day after tomorrow. Okay. Yes or no?
Okay, sir.
So just 1 minute. So your class is, I think, day after tomorrow, right? Okay. So let me start another chapter. Achha. This we have done. So can you see the slide?
Yes, sir.
So basically here we'll do the international monetary system, and before that let me also tell you what are the different exchange rate mechanisms. So you're talking about how the exchange rate is determined. We also talked about the intervention from the what do you call intervention from the central bank, etc., etc. All will be discussed in this particular chapter. Okay. So broadly speaking, this is a little bit of history. That is how we have come to this. A little bit why? Because it will not be possible to discuss the thing in detail. So broadly speaking, there are 5 market mechanisms. Okay, how the exchange rate is determined. So first one is freely floating, also known as clean float. So what do we do here? How the exchange rate is determined here? So last class, if you remember, we talked about exchange rate is determined by demand and supply, and what are the forces? There are 7 forces which mainly determine the demand and supply. So here also there is no intervention from anybody. Market forces, that is demand and supply, they determine the exchange rate. And which are the factors which determine the exchange rate mainly? And when we were doing those 7 factors, we also discussed that mainly 3. One is price level, that is inflation. One is interest rate, and the other is economic growth. So they are the 3 major factors that influence the demand and supply most. Of course, there are political stability, there are other things. So there are, current account deficit, all those factors are also there, but they are the 3 major factors that determine the exchange rate, that is demand and supply. Okay. And since there is no intervention by anybody, so price level means it is not only the price level of your country, it is price level of both the countries. It is interest rate of both the countries. It is economic growth of both the countries. And of course, expectations also play an important role. And of course, rates fluctuate over time randomly. Why? Because there is no intervention from anybody. Any changes, so naturally the interest exchange rate fluctuates. Any question? So since there are a lot of exchange rate fluctuates over a time, so there are problems. So problems means, suppose today $1 is equal to 75 rupees. So if it keeps on fluctuating, so it does not help actually anybody. If Indian rupee depreciates, it will help one particular segment. If Indian rupee depreciates, it will help another particular segment. Okay, but if it fluctuates, like it goes up, goes down, so naturally it will not help anybody. So there are problems with free float. So free float, it is not that it is not, this is not there, this is there. US dollar is a free float. UK pound is a free float. Okay. So there are many countries which are on free float. So there are problems with free float. Why? Economic uncertainties are associated with clean float. That is free float. So high rate of appreciation of the currency will affect exports. Suppose today $1 is equal to 75 and tomorrow it becomes 73. So it will affect it will definitely the exporters will be hammered. High rate of depreciation of the currency will lead to a high rate of inflation. Not only that, it will also hammer our importers. So again, there is a problem. So what to do? So normally the monetary authority, so which is the central bank of a country, it intervenes in the market. How it intervenes? So it allows the market forces, that is demand and supply, to determine the rate, but as soon as there is a volatility. Now, what do you mean by volatility? If it fluctuates a lot, or if it goes beyond the targeted rate of the central bank. Now, central bank always tries to keep a targeted rate. Okay, so if it goes beyond that, then the central bank intervenes. Okay, central bank intervenes and determine the targeted rate. I repeat, so in the normal course, the market demand and supply determines the rate, but if there is an excess volatility or if the rate goes beyond the targeted rate of the central bank, then the central bank intervenes and determines the rate. Okay. Central bank can intervene in three different ways. One is smoothing out daily fluctuations, which means suppose today exchange rate is 75 and central bank thinks and this 75 rupees is achieved by central bank after intervention. I repeat. So it's a managed float. So today $1 is equal to 75 and this rate central bank has achieved after intervention, and central bank calculates there is something called real effective exchange rate, which is determined on the basis of a basket of currencies. I'm not going into that right now. So when you calculate the suppose central bank thinks that actual rate should have been not 75, it should have been 73. Now, so rupee should appreciate from 75 to 73. But if central bank withdraws its intervention, so immediately rupee will reach to 73. Now, if that happens, naturally exporters will be hammered. So what central bank will do? Central banks can intervene in an orderly manner. Suppose central bank decides that we will achieve this exchange rate of 73 over a period of time. So every year central bank will allow the rupee to appreciate by a particular amount, which will be determined by central bank. I repeat the entire thing once again. Suppose the current exchange rate after intervention is 75, but if the intervention is withdrawn by central bank, so central bank thinks that the rate will reach to 73, rupee will appreciate to 73, and if that happens, exporters will be hammered. So what central bank can do? Central bank will allow the rupee to appreciate to 73, but in an orderly manner. How? Suppose central bank decides that it will allow the rupee to reach 73 over a period of 12 months. Okay, so what it will do? It will allow every month it will allow the rupee to appreciate by a particular amount, in which over a period of 1 year rupee can reach from 75 to 73. Similarly, it is also possible, suppose central bank thinks that if its intervention goes from 75, it will reach to 76. And so central bank decides this can be achieved over a period of 5 months. Okay, so every month central bank will allow the rupee to depreciate by a particular amount, and it will reach 76 over a period of 5 months. So this is what is called smoothing out daily fluctuations. Okay, any question? So leaning against the wind. Suppose it is normal course, it is 75, it is trading, there is not much of intervention by central bank, but suppose suddenly there is a huge amount of foreign portfolio investment, suppose $100 million. Suppose there is a portfolio investment of $100 million. So as soon as there is a huge amount of foreign currency inflow, naturally the rupee will appreciate against dollar. And if rupee appreciates against dollar, then what will happen? If rupee appreciates against dollar, the exporters will be hammered. So immediately central bank will intervene in order to make it stabilized at 75. Okay, so this is an intermediate. This is an intermediate intervention. So for a particular event, okay, or random events. Okay, so this is what is called leaning against the wind. And unofficial pegging is resisting exchange rate for reasons clearly unrelated to market forces, which China is doing. So devalue your currency with official pegging too. Now, officially, so there is something called fixed exchange rate, where you fix your exchange rate, which is announced by the government. So in this case, China is not allowing, and China is not announcing that $1 is equal to so much of 1. But by intervening in the foreign exchange market, China is trying to maintain that rate. China is devaluing its currency. No, it is not only China. There are many other countries which are doing that. China is devaluing its currency in order to boost export. So this is what is called unofficial pegging. Any question? Anybody? Third one is target zone agreement. So what is the target?
I have a doubt, sir.
Sure.
I have a doubt. That in the first process, when you mentioned that during the smoothing out daily fluctuations, you mentioned that central bank believes that if it removes its intervention, the price will go down to, the rupee will go to 73 or 76 or something. So how does the central bank determine that? Is it as per the conditions?
Real effective exchange rate. So with your trading partners, so trading partners in India's most of the cases it is US dollar. So with your trading partners, you calculate what should be the exchange rate. So that is, there is something called real effective exchange rate, which I am not doing now. You can give a search and find out what is real effective exchange rate, how it is calculated. So once, and it is there in the book also. So if you calculate real effective exchange rate and you find out that it is 73, that's all.
Thank you.
So it's not very difficult. So next one is target zone agreement. So basically, how you determine the rate? Market forces constant to upper and lower range of rates. So it is basically done with a, what do you call, with a group. See, best example can be euro. So when we will do foreign exchange market, at that time, we'll do this euro. So where the member countries before introduction of euro, so they had something called European Currency Unit. So every member country, they fixed their exchange rate with this European currency unit. Say, for example, it is decided, say, one European currency unit. Later on, this European currency unit became euro. So every member, they fix their currency. Suppose it is equal to 4 Belgian franc. It is equal to 2 Deutsche Mark. Rather, 2 Deutsche Mark equal to 1 European currency unit. 4 Belgian franc is equal to 1 European currency unit. 90 Italian lira is equal to 1 currency unit. So they, once you fix the rate, then all these member countries, they adjust their monetary and fiscal policies in order to maintain the rate. Now, you must have seen that monetary policy determines your which determines your interest rate also. So if there is and with interest rate, you can also target inflation. So if you increase the rate of interest, so naturally your exchange rate will change. Okay. So, but if all the member countries, they coordinate among themselves and have the almost similar kind of monetary policy, then you can maintain that exchange rate. Number one. What about fiscal policy? If you have a large fiscal deficit, that is your expenses are more than your income, so then what will happen? you will have inflation in the economy. If inflation occurs, naturally it will be difficult to maintain that rate. So you have to coordinate with the member countries for your fiscal policy also. So with the help of these economic policies, you try to maintain this rate. So that is what is called target zone agreement. Okay, any question? So once now they don't have any what do you call all these countries, so they don't have any monetary policy. Eurozone, we'll discuss that again later. Eurozone countries, they don't have any monetary policy, but however they have a fiscal policy. So that is why still there are problems. When we'll do euro, at that time we'll discuss this again. Any question about this target zone agreement? Next is fixed rate system. So government announces that this is the exchange rate. So prior to 1991, we also had a fixed rate system, but ours was not with dollar. Indian rupee was fixed with UK pound. So under a fixed rate system, what happens? You fix your exchange rate. Government announces that this is our exchange rate. So government fixes the exchange rate with a particular currency. It may be a basket of currency also. So rate is determined. Government maintains the target rates. How government maintains the target rates? By coordinating the monetary and economic policies. So you see, today, if we decide that is okay, we will fix our rate as $1 is equal to 50 rupees. Okay. Now in the normal course, if I want to maintain this rate, if India wants to maintain this rate, then we must follow the monetary and fiscal policies of US. Suppose we increase the rate of interest, so naturally it will be difficult to maintain that rate of rate. You must have seen how the interest rate affects the exchange rate. Not only that, if there is, we must have a control over inflow and outflow of foreign currency. Like FDI, there must be some restrictions on FDI and FPI. If there is huge amount of foreign portfolio investment or foreign direct investment, naturally our currency will appreciate. So naturally we will not be able to maintain that rate. So there are a lot of restrictions under a fixed exchange rate system. We'll see. So government maintains target rate, and there is a government intervention necessary, because if there is if there is a pressure on the exchange rate, suppose there is a huge amount of foreign portfolio investment, so immediately government will intervene. So supply goes up. So immediately government will intervene and buy the foreign currency in order to create a demand. Okay. So that is what is called central bank's intervention. Point number B, if rates threaten, central banks buy and sell currency. And you must coordinate your monetary policy. Otherwise, it will be difficult for us to maintain the exchange rate. Okay. And the last one, so there are some government controls, as I have told you. Global portfolio investment, just now I mentioned that there will be restriction on foreign portfolio investment, there will be restriction on foreign direct investment, and there will be also restrictions on import. Okay, so that these are the problems of fixed. That doesn't mean fixed rate is bad. The current system is a hybrid system. It's a combination of, one school of thought says that there can be only two rates. One is a free float and the other is a fixed, and others are only combination of all these. So that is what is the current system. So depending upon the situation. However, IMF has defined this exchange rate mechanism in a different way. So let me also, so first, this is, I told you, this is a broad classification, and this can be classified. Again, there are sub classification. Okay. So IMF adopted a new classification scheme in January 1999. So first one is called hard pegs. So what is a hard peg? The country does not have any currency. It uses another country's currency as its currency. So there is no legal tender. So the currency of another country is circulated as the sole legal tender and is shared by the members of the union. See, there are many countries which use dollar as their currency. They don't have their currency. Now I'm not talking about US dollar, Canadian dollar, Singapore dollar, Hong Kong dollar. It's not that. So there are many countries which use US dollar as their currency. I repeat, there are many countries which use US dollar as their currency. Probably Zimbabwe is also doing that. There is one country, I forgot the name, which uses euro as their currency. There is one country called, I believe you have heard, Liechtenstein, which uses Swiss franc as their currency. So this is this is called hard pegs. Peg means fixed, hard pegs. Then there is something called currency board system. When we will do Argentina crisis, you will see what is a currency board system. It's a monetary regime based on an explicit legislative commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate. So suppose you fixed $1 is equal to say 10 rupees. So if you want to print 10 rupees, you have to keep $1. Okay, so you can introduce 10 rupees only against $1, otherwise not. So you find, so what is the difference? Difference is here you find a legislative commitment, that is you pass an act. So currency board arrangement can be done only by passing an act. So Argentina crisis, you will see they had done this. So a monetary regime based on an explicit legislative commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate combined with restrictions on the issuing authority to ensure the fulfillment of its legal obligation. Any questions? So basically fixed exchange, these hard pegs, there are two things. One is they don't have any currency, and the other is, in this case, they have a currency, but that can be printed at a fixed exchange rate against a foreign currency. So a monetary regime based on an explicit legislative commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate combined with restrictions on the issuing authority. This is important. Combined with restriction on the issuing authority to ensure the fulfillment of its legal obligation. So who is the issuing authority? The central bank. Soft peg. So conventional pegged arrangement. So country pegs this currency at a fixed rate to another currency or a basket of currencies which India had earlier with British pound, depending upon the major trading partners, and weights reflect the geographical distribution of trade, services or capital flows, etc., etc. So it may be only one currency, it may be a basket of currency, depending upon your trading partners. This is the normal fixed exchange rate system, the conventional peg. Peg means fixed. Okay. Pegged exchange rate with horizontal bands. The value of the currency is maintained, like say for example, India has decided that the dollar should be within a band of 75 to 77. So as long as within a band of 75 to 77, so there will be no intervention. But as soon as there is it goes beyond that, there is an intervention, which is also the case for before introduction of euro. As I have told you, that is how they, before introduction of euro, they fixed their exchange rate with European currency unit, and they were asked to coordinate their monetary and economic policy, and they were member countries were allowed to, rates were allowed to fluctuate, say plus minus or some percentage, suppose plus minus 5%. As soon as the rate goes beyond 5% plus or minus, there is an intervention by the central bank. So this is what is called pegged exchange rate with horizontal bands. Crawling pegs. So the currency is adjusted periodically in small amounts at a fixed rate or in response to changes in selective quantitative indicators. Past inflation differential, vis-a-vis major trading partners differential, etc., etc. Okay. So crawling peg is basically another name. So you periodically adjust the exchange rate. It's a fixed exchange rate, but periodically adjust the exchange rate. Then comes floating rate regimes. So managed float we have already discussed. Normally, you have some exchange rate in mind. As soon as the exchange rate goes beyond that, so there is a central bank intervention, and this can be one thing, and there can be some occasional events or random events. Then also there is central bank intervention. But the most important thing is the central bank has some rate in the mind. As soon as the rate goes beyond that, there is a central bank intervention. So the monetary authority attempts to influence the exchange rate without having a specific exchange rate path or target. Indicators for managing the rate are BOP position, international reserves, parallel market developments, etc. and adjustment may not be automatic. Floating, as I have told you, other exchange rate is market data. The exchange rate is totally market determined with interventions occurring only exceptional cases. Only exceptional cases. And other managed float, any arrangement that does not fall any of this fall into this managed float. So this is the World Bank classification. Any question? Anybody? Is there any ideal regime? So if you have a fixed rates that provides a policy anchor and discipline. Why discipline? Normally it is expected that the developed countries, they have a monetary policy, disciplined monetary policy. Normally what we find is emerging markets, especially third world countries, their expenditures are more than their income most of the cases, and that is why there are high inflation, and if there is a high inflation, naturally there are high interest rate. Many of them, they keep on printing money. What happened in case of Zimbabwe, I told you. So, but if you fix your exchange rate with another country's currency, then what happens is, if you want to maintain that rate, then you need to coordinate your monetary and economic policy with that particular country. And since you are coordinating your monetary and economic policy with that particular country, which has a fiscal, which has a monetary discipline, so naturally what is happening? So there is a policy anchor and discipline. Freely floating rates provide monetary policy freedom. So when you have a fixed exchange rate, naturally you don't have a freedom. Why? Because you have to coordinate your monetary policy with that country's policy. But if you have a free floating exchange rate, then you have a monetary policy. So there are advantages and disadvantages of both the methods, fixed exchange rate as well as floating exchange rate. So is there anything, any ideal exchange rate? No. So it is no exchange rate is ideal for all the countries, number one. Similarly, no exchange rate is ideal for a country throughout. I repeat, no exchange rate is ideal for all the countries. Similarly, no exchange rate is ideal throughout. Okay, so we try to take advantages of both the methods, all the methods. So there is something called impossible trinity. So one side you try to maintain a fixed exchange rate, and the other side you want to have a monetary policy independence. So these three you cannot achieve together: a stable exchange rate, a monetary policy independence, and financial market integration with the rest of the world. So what do? So this is what is called impossible trinity. So one is monetary policy independence, one is stable exchange rate. Stable exchange rate is fixed exchange rate. So if you have a monetary policy independence and you have a stable exchange rate, then you must have a full capital control. Full capital control means restriction on foreign portfolio investment, restrictions on foreign direct investment, restrictions on import, etc., etc. So I repeat, you have a monetary policy independence, we had a stable exchange rate, so you have a full capital control, which was the case for India prior to 1991. Okay. So if you have a monetary policy independence and integration with the global financial market, what do you mean by? So there is no restrictions on, trade, there is no restriction on import, there is foreign direct investment, foreign portfolio investment, then you must have a floating exchange rate. You must have a floating exchange rate. You have a fixed exchange rate and you have integration with the global financial market, then you must have a currency union, which is the case for Eurozone. So Eurozone, they have a stable exchange rate. Why stable exchange rate? They are all the member countries, their exchange rate is fixed with euro, and they have integration with the financial market. They have integration among themselves. So that is why they have a currency union. Okay. Where does India fall?
So floating rate. Yeah.
See, India is managed float. Since India is managed float, India has monetary policy independence, but not fully float, managed float. So that is why, and India also has integration with the global financial market. So that is why there are some kind of restriction on the capital. So there are some kind of restriction on FDI. There are some kind. See, for example, as I've told you, telecom 74%. So there are many reasons. There is one is control, and the other is to save the domestic companies. So insurance again 74%. So these are all. So FDI there are restriction. FPI also it's not. Anybody can at any point of time can come and invest. So there are restrictions on FPI. So that is why India falls here. Any question? However, let me tell you, this impossible trinity is we are talking about monetary policy independence. So what should be the target? The last class, if you remember, what should be I told you what should be the target of a central bank? Low inflation rate, low interest rate, because if you have a growth, then you have to have some kind of inflation. Growth with recession is not possible. So when you have a growth, you have some kind of inflation, but a moderate inflation. Similarly, if nobody likes higher interest rate, so a moderate interest rate, and of course a targeted exchange rate. Targeted exchange rate means here I am not talking about stable exchange rate. Targeted exchange rate is here. So that is why you are talking about managed float. Now all these three difficult to achieve, but that is why we are talking about moderate inflation, low interest rate, as well as a targeted exchange rate. Okay. Now again, along with this, as I have told you, there is another factor which is also becoming important day by day. What is that factor? That is financial stability within the country. Okay. So just now I told you three. One is moderate inflation, low interest rate, as well as stable exchange rate. Now, if you think about the point, Indian condition right now, India now there is high inflation. You must have seen in the newspaper because of the one reason is definitely the crude oil price, and as a result, since the price of crude oil is high, so as a result, in the domestic market, the petroleum prices are high, so prices are going up. So one way to arrest the inflation is increase the rate of interest. Now at this moment, India cannot afford to increase the rate of interest, because if you see after COVID, for a long period of time, the interest first initially the interest rate were going down, but it has already reached its lowest level. Now RBI is not reducing the rate, not changing the rate of interest for a long period of time. Why? See, as it is, there is no demand in the market, because a lot of people have lost their jobs and all. So at this moment, corporates are not borrowing, they are not investing. Okay, because there is no demand in the market. Now, if you increase the rate of interest, government is insisting the corporates to borrow and to increase the production. But where is the demand? So at this moment, if the rate of interest goes up, naturally corporates will further stay away from the market. They will not borrow further. So that is why government is not increasing the rate of interest. Along with that, so there are a lot of, you must have seen, there are a lot of NPAs, a lot of defaults. So if you increase the rate of interest, there might be further default. Okay, this is one. Other things are there is, it is expected that next monetary policy in March, Federal Reserve is going to increase the rate of interest. So once Federal Reserve increases the rate of interest, there is immediate, though it is already factored in, so it is expected the foreign portfolio investors, they will also withdraw money from India and invest in their country. So in order to arrest that, there is a chance that RBI will increase the rate of interest. So at this moment, maintaining financial stability within the country is also very, very important. So though you have an independent monetary policy, but you cannot increase the rate of interest because you also have integration with the global financial market. That is basically not allowed. Why? Because if the Fed increases the rate of interest, and if the money is withdrawn from your market, again there will be instability. You will not be able to, it will be difficult for you to maintain the targeted exchange rate. Okay, so that is why there is impossible trinity is no more restricted to 3 factors now. So there is a 4th factor which is also coming into the picture. That is what is called financial stability. Is that clear? Any question? Anybody?
No, sir.
See, today I have only 3 more minutes. Next class, definitely remind me about, if I forget, definitely remind me about central bank intervention. So that is what I was about to start. So that is how central bank intervenes in the foreign exchange market. So you just remind me about sterilized intervention and unsterilized intervention. So I told you about here the central bank intervention, etc., etc. So how central bank can intervene? So we'll do that. Acha, here this is history of what do you call, how gold and other things and all. We'll do it very fast in the next class. So use of gold standard. So basically I would have it's history, why it is important, because how dollar is important today. Because dollar has over a period of time dollar has become important. So that is why we'll be doing. And here we have also discussion on little bit of International Monetary Fund, a little bit of a crisis which took place over a period of time all over the world, because when you talk about foreign exchange market, it is not only Indian market, it is also the other market. So any question, confusion? So next class, first read the 2 cases. Okay. So next class we'll start with the 2 cases definitely, and then we'll go to the we'll do what do you call central bank intervention, and this finish of this fast. Okay.
Okay, sir.
But read the 2 cases. It will not take, each will not take more than 10 minutes. Okay then. Stay safe. Stay healthy. Bye.
Thank you, sir.
Thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you.